Hi, everyone. I'm Rick Bensignor. Today is Tuesday, August 15th. Welcome to this week's In the Know Trader Show. What do we have on tap? The topic of the week: what's the best way to hedge your diversified portfolio's value? This is a very timely topic considering the market's pulled back from the highs we saw this year. And there's a variety of ways to do it, and I'll walk you through the different ways in which one I believe is the best way to do it. Before we get to that, let me tell you what we've got at In the Know Trader. So we have 3 written products plus coaching services. Let me walk you through it. The daily tip sheet comes out every day that there's a trading session. It's the night before I send it out to you. It gives you everything you need to know for the upcoming day, not only earnings and economic reports, but I do a deep dive into the spider on the support and resistance levels and what I am looking for to occur. I give multiple times a week. I'd say on average, probably 3 trading ideas a week. So it's not every day, but it's most days. And I walk you through, we've got a spreadsheet of all our open positions, anything that we need to do to move targets or stops or whatever, all gets updated, all in front of you in a matter of a 2 or 3 page report. It gives you pretty much everything you need to know. This is for active traders. And it also includes, exclusively to daily tip sheet subscribers, a webinar every Monday morning at 8:45 a.m. Eastern Time. I will do a macro market outlook, everything you need to know for the week, including all the different markets that affect the stock market. So we look at fixed income markets, commodity markets, foreign exchange, Bitcoin, and a deep dive into the S&P itself again, as well as looking at the Qs and all the different fixed income instruments that you should care about. All gets reviewed in that Monday morning webinar each week. Again, that is only for daily tip sheet subscribers. Secondly, a weekly ETF tactical trader report that comes out generally on Thursday evenings, goes through a deep dive of everything you need to know on the macro forefront, gives a new ETF trading idea each week, and then walks you through every trade we still have on, including updated charts, targets, etc. We move sell stops to protect profits. This has been doing outstanding this year, and again, comes out once a week and includes a new trading idea for each week. The third written report I have is the monthly 7-Eleven report. The goal of that report is over time to outperform the spiders, the SPY's performance. And I do so by having you in no more than 7 of 11 macro spider ETFs, such as XLE for energy, XLK for technology, XLF for financials, whichever 7, maximum 7 out of the 11 different sectors there are, I'm going to put you in with the goal of avoiding the underperformers and being in the right sectors at the right times. Here are the stats right in front of you. This year, we're pretty flat. We haven't been able to get materially ahead of the market. It's been a very tough year for every portfolio manager. So this year, not up anything at all over the S&P. Last year, outperformed the S&P by 601 basis points. And here's the most important thing. Over time, we now have a full 3-year track record for this report, which I started in August of 2020. So on July 31st, we have a full 36-month track record. If you had followed the recommendations in this report for the full 3 years, you will have outperformed the S&P by 14.29 percentage points above what the S&P has returned in the same time. So on a $100,000 account, that's 14,290 extra dollars you would have by subscribing and following a once a month shift in your portfolio. The whole thing takes you 10 minutes a month in order to reallocate to the percentages that I recommend of the 7 different ETFs that I put you into. If you can't give 10 minutes a month for your long-term well-being, I'm not sure what you're thinking about, but to be ahead of the market by roughly 14.3% in 3 years is astounding. There are very few people in the entire industry who are benchmarked to the S&P who can do that. And I've done it with a lower standard deviation of risk than the S&P has. So I've bettered its return materially, and I've done so by taking less risk than if you were fully invested in the S&P during the same time. If you're not subscribed to this 7-Eleven report, I don't know what you're thinking. I don't know why you wouldn't, but if you're in the markets and you don't have to be an active trader. This is just 10 minutes of time once a month to be in the right sectors at the right time to have substantially more money than if you were just in the spiders during the same time. To me, it'd be really foolish not to be subscribing to this report. Lastly, I coach both individual investors and financial advisors. A large portion of my week gets taken up with that. And for any of you who want to improve on the results you have, you can sign up for a single hourly session. You can sign up for a package of 3 that is deeply discounted. I've got people who sign up for multiple packages of 3 right from day one because they know they need help. And they're 1-hour sessions, and I work with you to help you improve to get better results. And as I say, because so much of my week gets filled up with this, there are lots of you who are in the No Trader followers who have come to the realization that they really do need help. And so that's what I do in my coaching services. All 3 written reports and the coaching services, you can find out more and are available to sign up on the website inthenotrader.com. If you're watching this, you're probably watching it on YouTube, and you can subscribe to the In the No Trader YouTube channel. Click on subscribe when you're watching. That way, when you open youtube.com, the most recent video I've done will pop up on that homepage for you, and it'll be right in front of you. So go to youtube.com/InTheNoTrader and click the subscribe button. Follow me on Twitter @InTheNoTrader. I think I'll probably start maybe doing something on Instagram also @InTheNoTrader. So that's the best way to follow what I've got to do. So let's talk about this extremely important topic as the S&P is off 85 basis points right now. Today, it's down about almost 40 points. Gave back all of yesterday's rally. It was a one-day rally right now. And we've now given up a couple hundred points from the highs that we've seen this year. And the bulls will tell you, oh, it's just a normal pullback. And the bears will say this market went too far, too fast, and there's a more substantial pullback in the midst. If you want to reduce the exposure you have in the market and hedge your portfolio, there are multiple ways of doing this, and I want to walk through how to do that. So let's talk about the best ways to hedge your diversified portfolio. And there's 4 ways that I can think of to do this. Now, there are combinations, and when we talk about options, you can do option spreads, etc. But let's talk about the basic, simple, different ways of doing this. First off, you could simply short the ETF for the S&P 500, the most commonly, certainly most active one by far, and the most traded instrument in the U.S. equity market day in and day out is the SPY, ticker SPY, representing the S&P 500. If you short the SPY, you're essentially selling the ETF, and you're in theory, by shorting, you're borrowing the shares to represent the SPY, and you will make point for point. Well, actually, spiders trade. The price of the spiders are the actual price is approximately 1/10 the price of the S&P 500 itself. So the S&P 500 right now is at, let's call it 44.50. That's going to put the SPY somewhere close to 445. They're 444 and change right now. So it's 1/10 the price. And there's a cost to borrowing the shares. Anytime you're going to short a stock, there's a cost to shorting, and it's the borrow cost. Something like the SPY, the most actively traded instrument there is in the equity market, the cost is minimal. It will not affect your long-term or even your short-term performance. It is very, very small. If you have some obscure stock and you want to short it, it's going to cost you more. But so I would not in any way, shape, or form think about what the cost is to borrow the shares to short the SPY. Now, some accounts are forbidden to go short, and therefore you may be limited by your brokerage firm, depending upon how you have your account set up and whether or not it's a retirement account, and et cetera, whether or not you can short something. Most accounts you should be able to short. You need to have signed papers for a margin account. But that's simple stuff that you can do and should have done previously. And if you haven't, just call your brokerage firm and say, I want to open a margin account. So one of the simplest ways to hedge your portfolio, and again, I will use the word a diversified portfolio, because if you have 6 stocks in your portfolio, and they're not kind of the major FANG names, but you have a constant, let's say, a lot of people end up owning a lot of stocks from the industry that was their profession because they think they have an edge in understanding those companies better than others. If you have, the bulk of your portfolio are, let's say, healthcare stocks because you were a doctor, then the spider is probably not a great hedge, because unless your portfolio typically matches what the market does, it's not a great hedge. If you have a broadly diversified portfolio, then the S&P 500 will most likely be a good hedge. By shorting the spiders in the amount of dollar terms of what your portfolio has, then if you want to, let's say you had a $1 million portfolio. Well, you would take the price of S&Ps at 444 up right now, the spiders, divide 1 million by 444, and that'll tell you how many shares to short. And then you would have, essentially, if your portfolio very closely tracks the long-term performance of the S&P, you will have a nearly perfect hedge on by shorting the spiders. So certainly one of the simplest, easiest, most low-cost ways of hedging your portfolio that's a diversified portfolio and is fairly closely matched to the S&P's performance. One of the easiest things to do is to simply short the SPY. Now, one of the things I didn't include here is that the SPY does not trade all day long. And there are times things happen at night where you might want to be able to put a hedge on, or buy or sell the SPYs when the New York Stock Exchange is not open. One of the brokerage firms, I have multiple accounts at multiple places, but one of the ones I have is, let's say, at TD Ameritrade. I use their Thinkorswim platform. TD Ameritrade lets you trade spiders 24 hours a day. So whether it's them or a market maker they are associated with, is making a market in the spiders even overnight. And it's based on how S&P futures are trading, so they can get a pretty good sense. And you're not going to get the penny bid offer spread like you do throughout the day in the spiders when the stock market's open, but it may be a 3 or 4 cent spread, but you'll be able to do something if you want. But just realize that in most platforms, it's not open all day. And there are times that you want to do something when the New York Stock Exchange is closed. How else can you diversify your portfolio? You can actually buy an inverse ETF for the spiders. The most liquid one is the ticker SH, essentially standing for short. So you can now use capital and buy the amount of exposure that you want to hedge. But think about what you're doing here, because now you're laying out more money to get downside protection. So if you had $1 million portfolio, you need another $1 million to buy $1 million worth of SH to now hedge the $1 million that you're long in your stock portfolio. So by definitely not the best way to hedge your portfolio, but it does solve the problem for those people who are not allowed to go short. This instrument lets you buy an inverse spider fund. So it will increase in value close to what the S&P loses in value. So the more the S&P goes down, the higher SH goes up. It's an inverse ETF. Now, let's get into options. You can certainly buy a put. A put gives you the right to get short a stock at a particular level at a particular time in the future. So you can certainly buy puts on the S&P. You can do it on the SPX, or you can do it on the spider. You can certainly do a put spread to reduce the cost, but it doesn't give you the full hedge as of, let's say, an at-the-money put. But an at-the-money put is also only going to gain 50% of the decline. And at some point, if you get a really big decline, it's not going to, eventually it'll start getting closer to dollar for dollar if it's deep in the money. But it's using options is not a perfect hedge, whereby, let's say, shorting spiders pretty much gets you will cover you for the downside move that the S&P would sell off. Using options, if you buy an at-the-money put, so right now with the spiders trading at 444 and change, let's say we bought a 444 put, you're going to lay out a certain amount of premium to have the right to be short at 444 in the future being the expiration date that you choose. Now, spiders have expiration dates every day, plus there are weeklies, plus there are monthlies. So you have tremendous flexibility here in the time period that you want to hedge for, but realize that buying a put, buying any option, is a wasting asset in the sense that every day that goes by that what you want to happen hasn't happened, you're losing some of the value of the premium that you paid on the day that you put this position on in the first place. So your timing has to be very good also when you're using options. So not only do you have to have the direction correct, you also have to have the timing correct. That's tough. Shorting the spiders just says, I'm willing to essentially eliminate all downside risk. If you use the spider and you sell enough spiders to cover your portfolio that you're long of stocks, what you've done is cap the ability to make money on the upside, such that if the market actually went higher, even though you're hedging because you think it's going down, but if you had $1 million portfolio and you sell $1 million worth of spiders, you've exactly capped, as of right then and there, any ability to make money on the upside. And what the hedge does is essentially dollar for dollar. Essentially, it's not going to be perfect, but essentially dollar for dollar, you are going to protect the downside, such that if the S&P sold off 5%, your short spider will sell off 5%, but because you're short, you're making the same 5% that your stock portfolio has just lost. Using options doesn't give you the exact same coverage. So understand that. If you're going to use options, you don't get that dollar for dollar coverage. In general, buying puts now with the VIX down, still where are we, in the 15 neighborhood or so? Where is it today? 1594. It's almost 16. But over the last couple of months, buying puts or buying calls, anything, but mostly buying puts, has been cheaper than it's been. In fact, buying calls has not been. Buying puts, downside protection, has cost you the least amount that it has in probably about 2 years, because the VIX got down to about 13 or 12. And last year, it was hanging out at 20 to 25 for a good portion of last year when the market was declining, which means that the price to the options was much higher to do the same thing now that you can do for much less. That's kind of the magenta colored part of this slide. You can also buy a put and at the same time short a call. That's a synthetic short. That is almost the same thing as just with a little imperfection of just being outright short. So similar to the SPYs, of shorting SPYs, but you still have the problem of expiration. Whereas if you short the SPYs, you've essentially right then and there capped any further upside that you can have. With doing a synthetic short, it's still only good for until expiration of those contracts that you have on. So it's not, to me, as effective a tool as just going short the spiders. So you don't get the exact correct dollar hedge either. It's close, but it's not as good. So out of the three things we've looked at so far, the three different ways to hedge a diversified portfolio, it sounds pretty clear to me, and I've purposely presented it that way, that the best choice is to simply short the spiders. But there's still one more way to do this. And the fourth choice is probably the best one. It's to go short the E-mini S&P futures, or even use the micro E-mini futures. So the value of one E-mini S&P futures contract is 50 times the price that the S&P 500 is trading at. So right now the S&P is at 4450. So if I take a calculator and I go 4450 times 50, each contract is covering $222,500 worth of your portfolio. So if you had $1 million portfolio, you kind of want to do about a little more than 4 contracts, right? Because if I multiply it times 4, that gets me just shy of $900,000 worth. But I don't have a perfect hedge on here. I'm still missing about precisely $110,000 worth of coverage. So I could use micro E-mini futures contracts to make up the rest. They trade at 1/10 the price of the S&P. So instead of $50 or 50 times the price, these are only 5 times. So each 1 point in the E-mini futures contract, each point that the S&P moves is $50 worth. In the micros, it's only $5 worth. So you could then get that extra $110,000 worth to have a full hedge on your $1 million portfolio by using a combination of the E-mini contracts and the micro E-mini contracts if you want to precisely, essentially cover your entire portfolio. What are the advantages to this? Well, usually futures are going to be the most cost efficient and easiest way to hedge your whole portfolio or a part of your portfolio. Let's say you only want to hedge $333,000 worth of $1 million portfolio. You can do that. Again, just do the math on how many of the E-minis you need and how many of the micros you would need to get to the amount you want. And you can very precisely fine tune that hedge. You need to put up margin money. And for the E-mini contract, last I looked, it was $11,200. That was when it covered 205,000 and now covers 225,000. It's still going to be in that neighborhood, maybe 11,300 or something like that. So you need to have that money available in your account as margin money. And it can be, most places let you margin stocks you own and things like that. So as long as you have that amount of value per contract in your brokerage firm, you're covered. There is some commission involved in futures that you don't have any longer trading stocks. So you can trade the S&Ps, let's say the spiders, for free. Futures, it will cost you about $6 to both buy and then sell. So let's call it $3 a round turn, something in that neighborhood. Do your shopping. Generally, one of the best places to, and least expensive, is Interactive Brokers. They probably have the lowest cost in the industry for commission costs to use futures contracts. It's still, when you think about it, a very small amount of money to hedge a few $100,000 worth of portfolio value. But one of the biggest reasons I'm going to tell you that I like using futures is because you get 23 hours a day out of the 24 hours in a day that the S&P futures can be traded. The only time they close during the trading week is between 5 p.m. and 6 p.m. Eastern time each day. For 1 hour, you cannot trade S&P futures. But otherwise, you have 23 hours a day, 5 days a week. And futures start trading at 6 p.m. Eastern time Sunday night. So you can already get a sense of what's going to happen Monday by how the futures are trading at night. And instead of potentially having to wait until 9:30 in the morning to trade your stocks or spiders, and again, some places you can trade spiders with extended hours. But futures are the most efficient, low-cost way of trading and hedging in the industry because they're the most efficient way. And they really become the benchmark way of looking at price. You know, we look at you watch the Bloomberg TV or CNBC or wherever you're watching, and you see the price of the S&P during the day, but you can't actually trade the S&P index. You can trade products that trade the S&P index. So you can trade S&P futures, you can trade spiders, right? But you can't trade the S&P itself. Using the futures contracts, because they're open 23 hours a day, gives you tremendous flexibility that you don't have, and especially if you're in the options markets, which don't have extended hours. So you're talking strictly 9:30 to 4 o'clock. I just found that I grew up in the futures markets. I traded on the floor of the commodities exchange for 12 years. I was a pit trader, and I traded stock index futures predominantly in my time in the pits. They are just I think, the best way and the easiest way, and you have access to them all the time, and you can always see what's going on. And, you wake up at 2 o'clock in the morning, you can see what's going on all across the world. You can see where Nikkei is trading. You can see what China is doing. You can see when London opens up and their futures markets, and of course the S&P futures and NASDAQ futures here. When I trade gold, I almost always trade gold futures unless I'm looking to buy gold for the long term. If I'm looking to buy gold for the long term as an investment, then I'll buy GLD or an ETF. But if I'm looking to trade, I use futures. They're just the most efficient way of getting things done. So my recommendation after looking at all four ways is first choice would be open a futures account, understand what futures markets are. These are highly leveraged instruments. Again, something like $11,000 or $12,000 is letting you control almost 10 times that amount. So a 1% move in the underlying has a much greater effect on the margin money you put up. But people don't, and there's actually somebody that I've been ripping who in Facebook ads who's trying to tell you that she's going to teach you how to trade futures so that you can get 10 or 15% returns on your investment. And what she's simply doing is taking the margin money and saying you get 10 or 15% on that. That's not getting 10 or 15% of the market. That's just 10 or 15% on what you put up. And if you're putting up $11,000 and the S&P moves 1%, that's already a 10% move on your margin. It's just terrible, misleading advertising. And I think for any professional in this business to do that is just wrong, misleading, and not at all what Rick Bensignor is about. So first choice, S&P futures. Second choice, use the SPY, and more places are potentially giving you the ability to trade spiders beyond the 9:30 in the morning to 4 o'clock in the afternoon. So at least you're getting more flexibility there. So that's by far my second choice. I would probably use options as the third choice, and I'd say the least beneficial way of hedging a portfolio is using that inverse ETF. There are costs to the inverse ETFs, and you have to buy and have more capital available in order to offset. So again, $1 million, you want to hedge a full $1 million portfolio using SH, you need another $1 million to buy $1 million worth of SH to be hedged. So not a good way to do it. That's it for this week. I hope you got some good value from the show. And I will be back again next week. And I'm Rick Bensignor. This has been In the Know Trader.